Past 2 years have been massively exciting in the Amazon FBA and e-commerce space because there has been so much money thrown around to buy businesses. Headlines have been ridiculous, multiples have been ridiculous, and a lot of people, even that I know personally and myself, have sold businesses that, I don't know, we might not have ever assumed we could sell. It's been an awesome couple of years, but the question we're going to ask today is, has that train started to slow down? It's going to be a great episode. Listen to the end, and here we go. Hey everybody, welcome to another episode of the AM/PM podcast. I'm your host, Tim Jordan, and today we are talking about money. I know usually I say we talk about business. Today we're specifically talking about money and big money in the Amazon and I would say broader e-commerce space. Now, when I first started selling on Amazon and other marketplaces, I remember everybody saying this isn't a business, right? It's not a business. There's no value in this. At any time you can get suspended. I remember thinking, well, gosh, I'm building something. I don't know what it is, but I'm building something. And maybe the answer is to get onto a direct-to-consumer website, right? If I can get on a D2C site, a BigCommerce site, a Shopify site, then I would have an actual value for this e-commerce business once I got off Amazon. And everything started to change several years ago. There's a couple before them. But the majority of the landscape started changing just a couple, 3 years ago when aggregators started showing up in big way, bringing large amounts of money and buying up businesses. Now, I've talked about aggregators before, and give me just a second to preach here for a second. I'll introduce our guest who is way smarter at this than I am. But you've heard me talk before about how I didn't actually like when the first aggregators came on the market because they were telling people your business is worthless, we'll pay you something for it. And what I liked was, maybe it wasn't that harsh, but it was close. Now what I have appreciated is so many other aggregators have come to the space that it created this ridiculous competition and everybody had to start paying more. And in the past 12 months, we've seen multiples for unbelievable numbers, unbelievable amounts. It's crazy how much people are paying for these businesses. And about 18 months ago, I started telling people it's going to come to a halt. It's going to stop. It's going to slow down. There has to be a balance because I'm looking at these product lists that some of these large, well-known aggregators are selling, and it's all crap. It's like no way in a million years would I try to sell this super saturated, commoditized stuff that no one's ever going to build a brand on, and it's going to be a dumpster fire. There's been a lot of headlines lately that were positive, and we're starting to see some negative. And in this episode, we're going to ask the question, is the aggregator boom now a bust? So I have one of the smartest guys in the space that I know. His name is Joe Hogg from Global Wired Advisors. Welcome to the episode, Joe.
Hey, Tim. It's great to be on.
Now, I want to hear a little bit of background, Joe. Don't give us the whole life story, but talk about basically why you're an expert in this. And I'm going to let you explain it, and then I might also re-explain why I think that you're the right guy to have on. But you don't traditionally come from an e-commerce space, do you?
No, I don't. My background is really capital markets, banking, investment banking. I have traded derivatives, foreign exchange, ran funding at a large bulge bracket institution. So my experience is very different than e-commerce. It's really more market centric, more, I suppose, M&A, capital markets heavy.
Joe, I'll be honest, I don't know what half the words are that you just said. You said bulge bracket. I'm thinking about a rusted out gate hinge or something. Yeah. I have no idea what that means.
Big bank is what that means.
Big bank. All right. Yeah. But this is good. And this is why I want you on. And this is why I love hanging out with you guys over there because you bring a different perspective to the space. I'm a blue collar firefighter. I don't know crap about nothing. Well, I shouldn't say that. I'm getting a little bit better. But the traditional and typical listener of this podcast, a smaller online seller, a solopreneur, they come from usually a different background. Most of them aren't coming from investment banking, but investment banking is now impacting our livelihoods. It's impacting our industry because investment bank is reaching down and investment banking is reaching down and touching this industry. So we need to be familiar with it. So when did you first become aware of this Amazon FBA business model from your banking background?
Sure. So I guess I should give you a little bit more context with respect to how we started Global Wired Advisors. So we were actually originally started in the lower middle market space, the small business space, as Providium Advisors. And Providium Advisors was really just the brainchild of three investment bankers and one CPG specialist to take a traditional middle market investment banking model down market into the lower middle market space, where we believed there was just a lack of expertise. Most most middle market investment banks really don't want to work with companies that are smaller. They prefer to work with companies that have enterprise values of 100 million or higher. And at the low end, there are a lot of business brokers that can act as intermediaries, but just not really provide the same level of structured finance expertise. So that was the thesis of Prevenium Advisors. And it turned out we got a lot of deal flow. There were a lot of smaller companies that really needed the expertise that we could bring down market. Well, after about a year or two of providing that to more traditional businesses, we noticed that just a lot of companies were coming
Let me
to
time
us.
out. You said traditional businesses. Are you talking about brick and mortar businesses? Are you talking about service-based businesses?
Non-e-commerce.
Non-e-commerce. Okay, got it.
Yeah. So they were coming to us that you just that needed, again, advisement with respect to deal making. So the consumer focused e-commerce deal flow we found that was coming to the Prevenium Advisors platform really needed to be handled differently. It needed to be separated out, and it required a different level of focus. So in doing that, we created Global Wired Advisors, basically. And Global Wired Advisors is focused entirely on the e-commerce consumer vertical.
So you came from larger business support in the investment banking world. The way you described it, you came down market into smaller businesses that were traditional businesses, and then you see this crazy world of e-commerce. What did your buddies in the middle tier of banking think about this new vertical that you were getting to in these smaller imaginary e-commerce businesses?
Well, I think that it was so new that people really didn't have an idea about what it was going to be. I think it was really quite novel. I think that e-commerce was at the time, again, this is going back 3 years ago, at the time was very fragmented. It was very say mom and pop like. It had not really been professionalized. It was very entrepreneurial. It was quite small. So pushing an investment banking model, a sell side model, down into this environment at the time felt to many people like overkill. It honestly did. A lot of people were like, "Wow, I think that the expertise that you're bringing down market probably isn't needed." And then, of course, we know the history of the space quickly professionalized as a ton of money moved into the space via the aggregator model. So I think again, we were timely with respect to how we were viewing the market, how we were approaching the market.
So it sounds like you got into the right time because you brought a professional background and professional knowledge and really professional team into a business community that wasn't necessarily professional at the time that professional money showed up. Right?
Correct. That's correct. Right.
And for those of you that are listening, we're about to get into some cool stuff here, and we are going to ask that question if things are slowing down. But I want to share my opinion of the acquisition space, the main four players in the acquisition space. Now, everybody knows the term aggregators. And if not, I'll tell you. Everybody knows what a broker is. Not many people know what an investment bank is. When you look at the especially smaller e-commerce business acquisition lineup, I see four components. The first one's a broker. And I sometimes have used the term like brokers like Craigslist. They basically can take your business and they can show it to people, right? Might not be a whole lot of polishing, might not be a lot of other support there, but it's being advertised. Then you have your aggregators, and these are these large roll-up companies that take a lot of money in debt and equity, and they buy your business with the intent of making it more operationally efficient, adding more money into it as an investment for advertising, whatever it is, and then creating a return on their investment, right? Because they're rolling up these businesses. And they're the ones that typically are trying to reach out to sellers and buy directly. Then I have what I call your broker pluses. This is not an official term. This is what I call it. These are your brokers that may have some legalese, right? They may have a little bit of experience. They may have a law firm embedded in them where they can do some deals and documentation in a legal way. And then I have what I consider true investment banks. And I used to not know the difference. Global Wired I like because these guys are true investment bankers, but it's hard for them to be understood in this space because it's so unique. some of the terms, Joe, you use, like I still don't know what those means. Bulge bracket, why does that mean big bank? I don't know, but now I know, right? I'll tattoo that on my forearm. So in this space, we have these four components. The aggregators really put a big boost into basically the whole industry, right? People are getting excited. People are selling their businesses. There was a lot more investment in infrastructure and software and logistics from all these other industries because they said money's being pumped in to support these sellers, and support these brands. Like, we have to come in too. So it was a fun time. There were some pretty crazy headlines in the past couple of years, right, Joe? Like explain what happened briefly in the past 2 years that just got everybody jacked up.
It really, I believe, all started at Prosper, actually. I think the aggregator thesis began circulating amongst a few people at Prosper in
Was
either
this like 2019?
Yeah, either 2018 or 2019. And, it was an entrepreneurial idea. It was, basically pulling two or three related brands together, finding an economy of scale, finding brand synergy, generating cash flow, and basically repeating the model, right? Repeating the acquisition model. And it was something that was really, quite frankly, from those early entrepreneurial ideas pioneered into a legitimate business by Thras. And Thras was the first out of the gate to successfully get a seed round done with this investment thesis and to make acquisitions that in the early days worked well, and then to raise extraordinary sums of money to pursue the whole roll-up strategy. And I think that in the early days prior to the pandemic, the model was thought of correctly. I think that the pioneers in the space were focused on cash flow. They weren't focused on generating revenue at all costs. They weren't focused on becoming a unicorn. They weren't heavily influenced yet by venture thinking. And it was really a disciplined roll-up strategy where acquisition multiples were assumed to be reasonable and cash flow was viewed as really kind of the necessary ingredient to make the whole thing work. And as we rolled forward into the pandemic, the thesis was supercharged. The aggregator investment model just exploded because, of course, we did something that we haven't done probably ever in the history of the world, is we sent everyone home for a year. And we basically said, you need to live and work from home, right? Yep. And then we stuffed them with transfer payments, unemployment benefits, et cetera, and they went crazy on Amazon. And it supercharged the entire investment thesis. And I think that there was a little bit of a disconnect. Well, there were a few disconnects, actually. The venture and an early investment money that flowed into the aggregator investment model flowed in with kind of, I hate to say it, but eyes wide shut to some extent. I think that the people that were pitching the model pitched it as, hey, look, we know Amazon. We know how to roll up brands in Amazon. We know how to basically operate the Amazon, be efficient operators of the Amazon machine. You need to trust us, keep funding us. We're killing it, right? We're growing like crazy. We're making a ton of money. We're killing it. And I think to some extent, a lot of the early investment dollars that were flowing into the space really didn't understand Amazon. I think that they viewed Amazon still as somewhat of a black box. I think they trusted the operators that were executing brand roll-up strategies, and they weren't really deep into these business models, right? And there was no reason to be at the time while things were working so well. The pandemic was tremendous tailwind that was providing, all of the validation that you needed that this was a great investment idea.
And that's when we saw the big headlines come in, right? That's when aggregators were raising hundreds of millions of dollars, and like everybody was just going crazy, right?
Yeah, they were going crazy, right? And it was something that quickly turned into a frenzy. It quickly turned into an investment frenzy that became validated through, again, just performance with many aggregators rolling up companies successfully.
And do you think that a lot of that frenzy was based on the growth of e-commerce sales that we were seeing, or do you think the frenzy was also on the headlines? This person hit unicorn status. This happened. Like, we better get in on this too.
Yeah, I think that the news cycle, of course, added fuel to the fire. But the model began to change when a lot of additional investment money began flowing in, and the venture mindset entered the space. Because the original model, as it was contemplated back in 2018 and 2019, was make acquisitions at prudent enterprise value levels and focus on cash flow. Ensure that whatever your capital structure looks like, whatever your debt equity combination looks like, just make sure that you're generating enough cash flow to continue the acquisition strategy, to basically have a buffer should you hit a bump in the road. Well, when we saw this influx of predominantly venture money, the model shifted over to becoming more revenue focused, to acquiring top line growth at all cost, because the idea was that eventually an aggregator of scale was going to get over the wall with respect to going public with an IPO, and was going to really validate the entire investment thesis. We would have an example of a publicly traded company, and we would have a multiple, probably off of revenue initially, but then presumably EBITDA, that we could use to value the rest of the space. The space, in effect, would move from mark to model to actually mark to market. And in that run up to this assumption that eventually someone was again going to get over the wall, was going to get public, you needed to get as big as you could. You needed to acquire as many companies as you could. You needed to roll up as many brands as you could to get as big of a scale as possible. And again, you were hoping for this this public securities transaction to validate the entire investment theme.
Let me make sure that I'm understanding, kind of in layman's terms, what you're saying. Basically, what you're saying is there are a lot of components that came together at the same time, whether it was an influx in sales, influx in money, this frenzy, the decision making of purchases and acquisitions and money spend not necessarily being based on profitability, but based on revenue, to value these aggregators to try to raise more money and eventually at least one of them get to IPO. So, I love the old term, what is it? Revenue is vanity, profit is sanity. So it's almost like the KPI for success for a lot of these aggregators was just buying revenue and not necessarily buying quality or buying profitability, right? So there's like 5 components that all blended together that caused this frenzy of artificial inflation of the market, artificial inflation of values or evaluations for the brands, for the aggregators themselves, even trickle down into the talent, the agencies, the logistics industry. Like, everything was artificially inflated, I believe. Is that a good assumption or a good assessment?
It was. Again, really what I like to tell people is it's impossible to understand the last 2.5 years exclusive of the pandemic effect. Again, it just can't be understated just how significant it was sending everyone home for a year and having them adjust their lives. And we've seen quite frankly structural changes in the economy that might be long lasting, that might stay with us for some time. So in understanding e-commerce and in understanding Amazon in particular over the last 2 years, it has to be understood in the context of the pandemic, what the pandemic did to consumer spending, and how those shifts basically impacted, again, this investment thesis, this aggregator investment thesis, and how it led to really the correction that we're in now. The correction insofar as the post-pandemic sales correction, the correction insofar as how aggregators now are going to navigate capital structures that probably don't work, how we're going to have to, in effect, see a cleanup phase in the space just to clear the bad positions that are in the market, that are in predominantly aggregator portfolios. And I think that, again, when you sync everything back to the pandemic and you go, wow, this was a generational anomalous event, and we saw tremendous investment flows associated with it into an investment theme and now we basically have to unwind a significant portion of that, then you kind of understand that there is going to be a little bit more pain. There's probably going to be, additional fallout. There's probably going to be, more bad news.
We've talked about all of these components that compile to accelerate valuations, and it worked this market into a frenzy, and there was an artificially induced inflation. Now you're talking about unwinding things. You're talking about things balancing and leveling back out and having that natural kind of like yin and yang thing going on. But what caused that? Were there components and elements of this industry that stimulated that slowing down? I don't know if that does that make sense to say that stimulated the slowing down, that increased the slowdown, or was it just a natural balance to begin with?
Well, that's actually the right question. I think that, again, understanding what happened in the context of the pandemic, if we look at consumer spending patterns, obviously when we sent everyone home, we stuffed them with transfer payments. They went nuts on Amazon. We created a shift in consumer spending away from services, which is actually 2/3 of the US economy, into goods, which is about 1/3 of the US economy.
Wow.
And that's a tremendous amount of money because again, services were shut down, travel, leisure, going to restaurants, bars, NBA games, et cetera. Couldn't do that during the
So you
pandemic.
reduced the spending ability of some sectors. You gave people more money, and now they can funnel all that into the only thing that they can do, which is buy crap and have it delivered to their front porch.
Correct. That's correct. So again, that supercharged online purchasing, by U.S. consumers, global consumers, and it also supercharged the aggregator investment thesis, and that was that you could successfully roll up brands, you could successfully grow brands and portfolio them, and kind of do that repeatedly. So I think that when the pandemic began to wane and started turning over into an endemic type of status, that consumer spending began shifting back towards services. Consumer spending, and there are a few nuances in there. We haven't really seen services recover fully with respect to goods, but you have
No,
to throw
but
in
some of the services are well beyond what they ever were. I'm trying
they
to book
are
flights right now, and I get on the phone with like my VIP concierge at American Airlines, and they're going insane because they're having the highest demand that they've had in 28 years.
they are
28
they
years.
are they
Insanity.
are It is, and that's what you're saying is people have been cooped up for 2 years, right? So now they want to get back to spending money on services, and we're starting to see that, but we haven't really seen that trend fully normalize, where we get back to the ratio where we were insofar as services relative to good
Oh,
spending.
so it's not just going back to normal, it's actually rebounded to the negative.
Well, we haven't quite. We actually still have above trend spending on goods and below trend spending on services relative to where we were tracking in 2019 and before the pandemic.
Can I
And
ask, how do you know all this? Where do you get all this information? Are you just
it's just,
Wikipediaing this, or like, who
well, I
knows this?
just right. Well, it's just macroeconomic stuff. We follow it. You should. It's in our quarterly house view stuff. We actually have our quarterly house view that's coming out with Prosper. We're going to be presenting a Prosper remix, and we're going to roll out our quarterly house view. And a lot of this is in there. And I'll give you a tease for that. We're actually introducing something new there, which is going to be an index for tracking Amazon selling conditions. It's going to be basically 9 or 10 different components that will give you a feel for what Amazon selling conditions are through time. And I think that's really what's been missing in the community is a map of sorts to.
And that's what you're talking about right now. You're talking about
Yeah,
how we probably should have seen this decline in product sales online coming, but no one thought to
correct.
look.
No, they didn't. So, when we roll the index out, it's going to be quite clear because it's going to draw a picture of where we've been and where we are now, and then you're going to offer some advice on where we think the index is going to go, and of course, we're going to release it monthly so that we can track conditions, selling conditions. Any data that's high frequency data that we can track, where we're looking at how people are moving around. Most of that data is showing that we're back close to call it 85 to 95% of where we were prior to the pandemic. So that's a good thing. However, again, going back to the goods services split, I think what we're seeing is because of inflation, we're seeing a shift again in consumer spending where people are now moving from discretionary to staples. And that I think is keeping goods spending a little bit elevated because everything costs more, and service spending is a little bit lower because people are still holding back. We're not back to 100% of where we were prior to the pandemic. And I think we're probably going to see more of that as inflation stays with us for a while. I think that, it's something that, obviously the Fed is going to address here, over the course of the year quite aggressively, we believe. But, this the shift is confusing a number of people that we've spoken to, because in looking at aggregate online sales, say for Amazon, they were, based on the last quarterly earnings report, up like 4%. Well, people scratch their heads and they go, well, wow, my sales are not up 4%, 4%. I'm significantly, worse than that. I'm not tracking that at all. And, for a lot of us in the community, we're focused on discretionary goods. We're mostly selling goods that are not consumer staples.
We're selling widgets and home decor and,
Right.
accessories and like crap that we don't need. We're not selling toilet paper and oatmeal.
Exactly. That's exactly right. So,
So I want to pause for a second and just make sure that we're staying, that everybody's following what we're talking about here. And all of you listening, understand that we are on track, right? That the question that we're asking is, did this big boom that everybody got excited about, has it turned into a bust? And now what Joe's explaining to us is some things that are happening that are slowing down. I won't say slowing down the economy. I won't say necessarily slowing down sales. I won't say slowing down the industry, but things that are slowing down the excitement, maybe, that the aggregators' quote unquote success was riding on, right? So, one, we've got less spending. And a lot of these aggregators, I know they sell tchotchke stuff. Like they sell stuff that's not a staple. So their sales are down because consumer behavior has adjusted. How big of an impact has the logistics situation been on aggregators' performance as well?
It's been significant because, obviously the just tracking container prices are staying just ridiculously high. I mean, if we go back prior to the pandemic, you could move, a container from Shanghai to LA for 2,500 bucks. It got as high as 55, 60 grand. I think it's back now, around 45, but it's still very expensive, right? So the shipping has been an enormous problem. The bottlenecks that we've seen through the supply chain have
Yeah,
been
and not just
something.
shipping costs, but actually getting your products. I mean, I have a friend over at Reuters, and her entire job has been to follow the Long Beach port congestion for 2 years.
Yeah,
Someone
exactly.
sent me an image right now of the Shanghai port because Shanghai just went through a big lockdown for COVID. And there's
Yeah.
like 2,000 ships anchored out outside of Shanghai, which is, I think, the second busiest port, maybe the third busiest port in mainland China. So even if pricing hadn't increased, people are just running out of stuff to sell.
They are. And what's happening in Shanghai definitely bears watching, because 20% of all the things that go in and out of China go through the port of Shanghai. So it's a tremendous manufacturing hub. And right now, China is insistent on maintaining what they refer to as a dynamic zero COVID strategy. And that is basically aggressive lockdowns followed by testing, more aggressive lockdowns if needed. And China is the beginning of the supply chain. So if we are looking at Shanghai going through a spike in COVID cases and China maintains a zero COVID strategy, we are going to see shortages of key components. There's no question about it. So much is manufactured in Shanghai and around Shanghai that it is going to create additional shortages.
And the reason this question about the aggregators is so important is because the success of the aggregators can somewhat represent the success or potential success of an online, especially marketplace seller. Because your Amazon, your Walmart, your eBay sellers that were selling their own products, they really started increasing their value. Like people became wealthy very quickly when the aggregators with this new roll up business model came on scene. So the success of the aggregators, although there's plenty of ways to sell your business, folks. I'm not saying the aggregators are the be all end all. There's a million people to sell your business to, but they were like the flagship. They're the ones that came out and said, all right, everything's happening. And frankly, they were typically the easiest to exit your business to, right? Particularly if you had a product that nobody should have bought anyways in some cases. So the reason that we're really, really curious, like really want to know if this aggregator thing is a boom or a bust, is because it can significantly impact or determine the potential success of Amazon online private label brands, right? That's, folks, why we're asking this question.
It can. And I think that it's
And again,
easy.
not being a Debbie Downer, not saying
Right,
that because
no,
a company didn't IPO, your company is an online seller's toast, but like
right.
it does take some wind out of the sails.
It does. And, again, it's difficult to understand outside of the context of the pandemic. And what I always tell people is when you have an anomalous situation, and again, we're all to some extent guilty of extrapolating through an anomalous situation where you go, wow, sales are taking off. Wow, business valuations are taking off. Wow, this is fantastic. We're reaching, into kind of a new operating model where there's just going to be a ton more business that's done online. And it's really been more of an anomaly. And that extrapolation breaks down. Conversely, as we're going through the unwind of a lot of this overinvestment in the aggregator thesis, it's easy to extrapolate downward and say, oh, wow, it's going to impact, online sellers for years. Oh, wow, the aggregator investment idea is something that just didn't work. Oh, wow, there are going to be so many losses and there's, going to be, so much hardship. And I think that's wrong too. I think that there's probably going to be more bad news. I think that there's definitely a need to clean up bad positions.
When you say clean up bad positions, are you talking about aggregators that need to scrap their bad ASINs? Or are you talking about investment funds that have invested in a lot of aggregators needing to clean up some of the bad aggregators?
Yeah, I think that it's a little bit of everything. So most of the acquisitions that were executed in the space were executed with debt. So say of the 15 billion that was raised, probably 13.5 billion of it was in the form of debt. The rest was in equity. Most of the equity, we've come to learn, was used to support aggregator G&A, and the debt was used to basically pay for acquisitions.
Yeah. So
Well,
basically, folks, what he's saying is the businesses that people bought were usually buying them on credit. They were borrowing money to buy the businesses.
correct. So whenever you're working with venture capital and they're funding acquisitions through debt, there are going to be a lot of debt covenants that are associated with the debt that's provided. And those debt covenants govern to a large extent how you're going to operate your portfolio. And a lot of debt covenants are going to have liquidity provisions in them that basically say, okay, well, you have to be cash flowing this much or have this much in adjusted EBITDA or SDE for us to be comfortable with respect to the existing debt we've provided, and especially comfortable if we're going to provide additional debt. So when we start breaching those covenants, we start running into issues from debt providers where they are going to be inclined to offer suggestions to management about how to improve operating results to ensure that their position as debt holders are not imperiled. Well, that works for only so long before I think you run into a situation where there really isn't a lot you can do. Now, what a lot of debt providers in the space are doing is they're strongly suggesting consolidation. They're saying, hey, you guys should merge with you guys, vice versa. But when you have a management team and equity that's basically still in place in an aggregator, it's difficult really to force those types of combinations. So I think what we're probably going to get to is a point where debt is going to be forced to probably execute debt to equity swaps where they blow out a lot of the existing equity in aggregators. They basically assume that equity position. I think there are going to be a number of write-offs that are going to have to be taken with respect to debt that has been provided. But then you're left with, again, kind of going back to the bad position comment, you're left with fewer bad positions. Basically, you're not over levered.
Joe, you're making this sound so gentle. You're talking about write-offs and you're talking about debt to equity swaps. You're talking about the VC funds coming and saying, "Hey bro, you owe me money. You can't pay it. I'm either going to hostily take your business or we're going to write you off and you're done." So a lot of, I won't make a speculation on, the aggregators that'll survive this, or the aggregators will be rolled up, but like a lot of the products and the brands that I think that friends of mine sold to aggregators are going to disappear. Like they're just going to be washed out.
Yeah, a number will. I think that there are going to be a number of brands that are just going to be allowed to attrite. I think there are going to be some circumstances where brands can be effectively sold out of aggregator platforms. But for the most part, the way this is resolved is, the way most over-levered debt crises are generally resolved, and that's blowing out existing equity holders to some extent, mostly a large extent, bringing in new equity, writing off bad debt, and basically providing fresh management, fresh capital, and clearing the deck, so to speak. And I think that
This sounds like a bust. So in the question, is the aggregator boom turning into a bust? This sounds like ominous to me, right? Like you're the guy with the data. You're the guy that understands this world better than any of us listening to probably. Like to me, this seems scary. So would it be, and I know you're not going to shake your crystal ball and make a blanket statement, but would it be safe to say that the big boom, the excitement, the amazingly cool headlines that we've experienced for the past 36 months are probably going to disappear for a while? And the headlines will probably be consumed by not so good news. Is that safe?
I think that's safe. I think that, but again, it's something that you don't want to over extrapolate, and
Exactly.
it's something where again, it's easy to say, well, the tide has definitely changed. Things could be getting a lot rockier over the course of the next quarter or two. It feels bad. It feels terrible. Oh my gosh, right? No, I think that it all comes down to your perspective and timing, right? So if you are in the space and you're basically looking at doing things in the space over the next quarter or two, well, over the next quarter or two, it might be rough. But if you're looking at being a longer term player in the space over the course of the next year, 2, 3, and onward, then it's going to be great. It's going to be great because once we go through, again, what I would probably would like to refer to as a little bit of a cleanup phase insofar as the aggregator investment
Such a
thesis.
diplomatically correct
Yeah,
answer.
right. We're going to be in a position to grow again. And I think that there's going to be no shortage, absolutely no shortage of investment dollars that are going to flow into funding acquisitions that are directly involved in Amazon. I think that it's something that isn't going to go away. I think it is something that is absolutely 100% here to stay. I think that a lot of people got carried away with respect to the pandemic effect, and it's supercharging the original aggregator investment thesis. We're going to again have to clean that up, and I think once we do, it's going to be forward ho. I think that there is long term really going to be no loss of momentum. I think that you're going to have a lot more investment dollars flow into the space. I think that you're going to have traditional PE that is not necessarily early stage or venture get a lot more involved in the space. And we're already kind of seeing that, on the fringe. I think that you're going to see more of that. I think that we've really taken an investment idea, we've ridden it to a top, which was an anomalous top based on a once in a lifetime event, the pandemic, and we got carried away. Now we need to unwind a lot of the the leverage that was applied to acquiring brands that just were not going to cash flow, and we will. I think that just like every other over-levered investment idea that we've worked through in the past through any number of asset classes. We're going to do the same here. And I think when we get to the other side of it, we're going to go right back to growing. E-commerce grows about 15% a year. I think that we're going to get right back on trend, in probably 2 or 3 quarters, we'll be right back on trend. And I think the operating environment will be stable again. We will have gone through this phase of,
We'll have learned a lot.
we will learn a lot
Everybody.
of cleaning up
So
bad relations, right?
I think
And
that the reason this question was important, Joe, and like the reason I really wanted to have you on and talk about this is because there are rumors about massive aggregators making massive layoffs. I know senior leadership at aggregators that are calling me and saying, like, this week, like, hey Tim, I need a job. Holy
Mhm.
crap, like this is bad. We know that the venture capital funds are squeezing pressure. We know that people aren't getting payouts, and it's scary because we saw this crazy awesome thing happen where like we're all going along for a ride. This e-commerce business thing is legit. We're all going to get rich. This is going to be amazing. And now it's like, oh my gosh, someone has knocked a hole in our boat. And that's what I wanted to get to the question of, is like, am I crazy in assuming that this thing is slowing down significantly and that the rumors are not necessarily rumors, they are truths. And like we are going to have to face a tough time, which sounded like you are. So I think that if we had to answer the question, from what I'm understanding, is the aggregator boom a bust? Maybe the aggregator boom is a bust, but the acquisition and investment boom in small to medium sized businesses and e-commerce is just getting started. Is
That's
that a safe assessment?
characterized perfectly.
Yes.
Characterized perfectly.
I don't normally
Yes.
get something right, especially talking about something complex. And folks, this is why it's important, because every big thing in life, has to have a balance. Every big wave has a big trough behind it. And we, I think, as e-commerce sellers and entrepreneurs and solo hustlers, are so wrapped up in what we do every day, and every single dollar counts, and every single success and failure hits us with the highest highs and the lowest lows. And we need to recognize that this is a long-term play. This is chess, not checkers. And we don't need to freak out. We don't need to panic. We don't need to just completely lose our marbles over the next 2 or 3 months when we see these headlines and these, as Joe likes to call, the cleanups happening, as big, well-known brands and companies take a big dump. Like, I really think that's going to happen. If we can live through that, and if we could survive through that, basically what Joe, the smart guy, is saying is, like, it's not over. This is just a small dip. But what's going to be cool about it, and I had never thought about this, Joe, until you said this, a lot of our really aggressive competition is going to disappear. Not just products, but the biggest spenders of very aggressive, overpriced PPC right now may not be around too much longer, right? Like, the guys that were occupying all of that organic search result page with a bunch of bullcrap junk that may have sold to big aggregators, and now they've wiped that off the slate. Like, we that are doing things the right way and actually building legitimate brands and building legitimate sales channels, like, it may get actually really good for us.
It may. And, with respect to PPC, my hope is that if we are going to have to go through this cleanup phase, hopefully, PPC goes down some. That would be my hope.
Yeah.
I'm not convinced of that yet, though, because I think that aggregators, believe it or not, are still such a small sliver of overall Amazon-based business ownership, believe it or not. So when you just look
Yeah.
at your total GMV owned, they still don't own enough, which again gives me hope that there's a lot further to go for the investment thesis once we normalize the economy, once we basically consolidate and clean up the space. I think there's a lot more to do. But with respect to PPC, I think PPC is just a result of more people getting involved with Amazon.
Yeah.
I think the space is professionalizing outside of what aggregators are doing as well. So that's
So you're
maybe a
telling me not
topic.
to get too excited. You're telling me to hold
Yeah,
on, things are gonna get good, but don't get
yeah.
too jacked up, because that swing is actually not as a big of a swing in the overall community and the overall environment as it is specifically related to like the Amazon FBA roll up aggregator community. So I know we're running out of time. This is one of the longest episodes we've recorded in a while, and I could keep talking to you for 6 more hours, but I know that all the listeners on Spotify and iTunes are going to get all hacked off for making us go too long here. But I know that, like, the reason I have you on, the reason I had one of your business partners, Chris Schifferling, on, I think close to 2 years ago or a year and a half ago, is because you guys don't just pull stuff out of your butts and make it up. You actually do a lot of research, and you guys have written some of the best white papers and some of the best articles I've ever seen in this industry. They're mind blowing. If anybody listening wants to go and completely nerd out reading these industry reports and these industry predictions and things like that, globalwiredadvisors.com. Is that right, Joe? Globalwiredadvisors.com. Definitely pick those up. If you ever come to a conference and you've walked around and run into some dudes from Carolina in blue jeans and tennis shoes and a polo shirt that don't look like what you would imagine like higher tier investment bankers looking like you may run into these guys. And Joe, that's one thing I love about you guys is you saw us little people down in the e-commerce space and you bring your experience, but you guys you actually know Amazon. Like you guys actually have your own Amazon products that you launch now. Like that's pretty amazing.
Yeah, we do. Yeah, so we're always looking for investment ideas and trying to build businesses and trying to build brands in the space as well. So it's it is.
So you get it. You understand it from both sides.
We get it, and I'd like to leave you with one thought.
Okay.
There through the aggregator investment boom, there has been really, I would say, super increased awareness of what people's businesses are worth. That was one consequence of, again, the aggregator phenomenon is everyone was focused on where they thought their business could trade, what they thought an appropriate multiple for their business was. And that was kind of concurrent with the entire phenomenon. Well, what I would say is now, really the thing to do is to focus on your business, to focus on building your brand, to focus on being a successful seller on Amazon. The aggregator takeout or the takeout or the buyout of your company by anyone is not something that should be validating the value of your business. It is there to serve you. The aggregator bid for your company or any bid for your company is there to serve you. Right? Your company is what you make of it every day. And what I would say is focus on building your company. Don't focus on what you think a multiple is going to be in a quarter or two or where it was, a year ago compared to where it is, today. That multiple, that takeout offer is going to always be moving around. Again, it is there to serve you. It is not there to validate what you're doing as a seller on Amazon. So I would encourage people to again focus on their companies, focus on their brands, and focus on doing what they know, and not on basically where aggregators are, what's happening in the aggregator space, where the multiple for your company is. I think that is something that can be focused on in time.
Amen. I love it. Folks, you know that we don't do sales pitches on this show, and Joe hasn't given one, but I'm going to give it for him. Check out globalwiredadvisors.com. Check out their data. Check out their information. I think it's the best in the industry, at least from what I've seen. And I haven't really looked that much. No, I'm kidding, Joe. I actually have looked. But thank y'all for being on. If any of you listening have any questions or comments, post them in the reviews on whatever podcast platform you're listening on, or in the comments section if you're watching this on YouTube. And what a great episode. I don't really know what else to say, but Joe, thanks for being on. Thank you all for listening, and we'll see you all on next week's episode.